Hello again, this is Jason Dahl with AFS. We're going to get started here with today's webinar, Tax Efficient Charitable Giving Strategies under the New Tax Law. As we were preparing for this, I think it applied even under the old tax law, some of the strategies we're going to go over today, but in particular, there's some really good tips we're going to cover today under the new tax law. So again, my name is Jason Dahl. I am a certified financial planner with AFS, and I am a volunteer member of the board of directors for A Wider Circle. And I am very excited for today's webinar, as this is particularly special to me. I'm going to turn this over in a moment to two of my mentors in my life, Alp Adebeck and Mark Burgell. So this is pretty cool from my vantage point. And we came up with the idea for this webinar because we believe in charitable gifting and the positive impact it has on people's lives and the economy as a whole. We want to reassure people that the new tax law doesn't mean that you need to give less, but rather that we need to rethink our strategies for tax-efficient charitable gifting, which we will share with you today. And my goal with today's presentation is to really debunk many of the myths involving the new tax law, resulting in fewer donations because of the limitations on itemized deductions. Here at AFS, implementing tax-efficient strategies in all aspects of our clients' financial lives is something we do on a regular basis. And we also recognize that it isn't the tax deduction that incentivizes our clients to give, but a desire and want to do good. Now, our role is to help our clients use this pension to do good to benefit themselves too. So as I mentioned before, leading today's discussion will be Alp Adebeck and Dr. Mark Burgell. Just a quick intro. As some of you may know this, but Alp graduated college with a degree in accounting. He passed the CPA exam immediately after graduating and opened his own firm in 1984 that focused on tax preparation and small business accounting. That firm was AFS. And in 1988, he began offering his clients financial planning and investment management services to complement his tax and accounting practice. In 2000, he sold his CPA practice to focus entirely on financial planning and investment management. And here we are today, nearly 31 years later. Now, I met Dr. Mark Burgell when I was a senior at American University and had the opportunity to intern with him out of his living room right at the beginning stages of A Wider Circle. And that living room was just across the street from here, as a matter of fact. It has been incredible to see the difference he has made in this community and the impact on so many lives. And it's important and obviously related to today's conversation that the positive impact would never have been possible without the thousands of volunteers and financial donors who have supported A Wider Circle over the years. So now I would like to turn it over to Alp Adebeck.
Good morning, everyone. We are going to start off with a little bit of accounting humor, if we can get this slide to advance. A few of the standard tax jokes. In the past, tax reform never meant simplification. However, the Tax Cuts and Jobs Act of 2018 did actually simplify things by limiting or eliminating certain deductions and increasing the standard deduction. It made it more difficult to itemize deductions. If you did not itemize in 2018, then that means you did not receive a tax benefit for making charitable contributions on your 2018 taxes. Today, we will help you understand a few of the changes in the tax law and share a few ways to work around them, and I'll add legally. Under the new tax law, regardless of your filing status, you received a larger standard deduction in 2018, but you no longer got a personal exemption in 2018. In 2018, if you filed as a single taxpayer, your standard deduction was $12,000 compared to $6,350 in 2017. If you filed married filing jointly, your standard deduction was $24,000 versus $12,700 in 2017. Taxpayers 65 and older get a larger standard deduction. If you file as single and are 65 or older, you get an additional standard deduction of $1,600. A married couple, both age 65, will now get a $26,600 standard deduction. That's $24,000 plus an additional $2,600 for being 65 or older. One of the biggest changes in the new tax law was the cap on what is called your SALT deduction, which is your deduction for state, local, and real estate taxes. This deduction, previously unlimited, is now capped at $10,000. This is a major change for taxpayers in high-income tax states such as Maryland, DC, New York, New Jersey, California, and Massachusetts. In our example, we show you a taxpayer that pays $12,000 in real estate taxes and $24,000 in state income taxes. In 2017, that taxpayer was able to deduct the full $36,000 paid, but in 2018, that same deduction is capped at a whopping $10,000. For charitable contributions, the reason we're here today, there really were no changes. Basically, the same rules apply. So what we're talking about today is just how to give some of these contributions potentially in a more tax-efficient manner. The combination of the larger standard deduction, the cap on the SALT deductions, and the elimination of miscellaneous itemized deductions, and that's eliminated from 2018 to 2025, will make it so many people will not itemize in 2018. In our example, we have a married couple with $22,500 of deductions. In 2018, with a $24,000 standard deduction for taxpayers married filing jointly, the taxpayers will no longer itemize because the standard deduction is larger than the total of their itemized deductions. Under the new tax law, if your house is paid off or you have a small mortgage, you may not be able to itemize unless you have a substantial amount of charitable contributions or a large amount of deductible medical expenses. For the most part, most of the other deductions have been eliminated for a number of years. As I mentioned earlier, there are some planning strategies to work around the new tax laws. Here's a tax planning strategy called bundling. Bundling deductions is the process of lumping payments you would make over multiple years into one tax year. Bundling deductions will potentially allow you to itemize your deductions in certain tax years. We are primarily seeing this strategy used with charitable contributions, but the same concept can be used for taxpayers with a substantial amount of deductible medical expenses. We have a great example on the next slide. In this example, we have a married couple that normally has $23,000 of itemized deductions, of which $10,000 are charitable contributions. So under option 1, which is the left side of the screen, you see that they get the standard deduction in 2018 and 2019 because their itemized deductions are less than the $24,000 standard deduction. They made one change in option number 2. Instead of giving $10,000 of charity in each year, they gave $20,000 in 2018 and $0 in 2019. In our example, they now have $33,000 of itemized deductions in 2018, and they take the $24,000 standard deduction in 2019. This simple move allowed them to increase their deductions by $9,000 over the 2 years. I should note that if you file as single and had the same deductions, you would be able to itemize, and the bundling strategy is not needed. And that's because you have the same deductions, but the standard deduction is less for a single person, so a smaller hurdle to get over. Another tax planning strategy to consider is to donate appreciated securities instead of cash. Let's say you own 100 shares of XYZ company stock worth $10,000 with a tax basis, which is what you paid for it, of $2,500. and you normally make a $10,000 charitable contribution to your favorite charity each year. Instead of sending them a check, consider donating your 100 shares of XYZ company to your charity. You still get a $10,000 deduction on your taxes as long as you itemize, but you never had to pay tax on the appreciation of your shares. Most charities are aware of this tax strategy and have the processes in place to receive gifts of appreciated securities. One thing to keep in mind, the shares you donate have to be held for over 1 year. Now, if you have the appreciated securities and you still liked holding that company's stock, you can always donate the shares and actually buy back new shares, and you're actually in the same position. You still hold $10,000 of the shares, but now you've actually set it to where you have a higher cost basis and you start a new holding period. But essentially, if you like the company, you can really be back in the same situation, but you've now donated in a more tax efficient manner. Another tax planning strategy to consider is the use of a donor advised fund. Think of the Bill and Melinda Gates Foundation. They essentially donated their zero basis shares of Microsoft to their own foundation and received a tax deduction for the donation. Today, through the use of a donor advised fund, many people are setting up what is basically their own personal foundation to help facilitate their charitable endeavors. And it's very easy to set up. You donate appreciated securities or cash to the donor advised fund and claim a tax deduction for the year that you make the donation to the DAF. This is a great vehicle to consider if you are bundling your charitable contributions or if you're trying to reduce your tax burden in a high tax year. You then make donations from your donor advised fund to your qualified charities whenever you want to make them. Remember, you already got a tax deduction when you funded your DAF, so you do not get another deduction when you make the donations from your DAF. And one thing to keep in mind, once you actually donate the securities in your donor advised fund, you can actually sell them inside of the charity, and there's no tax consequences for selling the shares inside the donor advised fund. And you can now actually diversify the holdings there or just leave it in cash. Here's a summary of some of the advantages of using a donor advised fund. Planned gifts can be made in the tax year when they are most tax advantageous. Grants to charity can be made at your convenience. Administration and record keeping are handled by the organization that sets up the donor advised fund, so you really don't have to do anything there. Convenience of online and mobile accessibility. And it really is a great way to donate appreciated assets.
Alf, I just wanted to interject. You mentioned something on the previous slide about taking advantage of a gift to donor advised fund in a high income tax year. I just want to point out perhaps the obvious, but for some folks who may be approaching retirement and you're at your peak earning years, these last few years while you're earning are a great opportunity. If you know you want to continue to give to charity throughout your retirement years and get the biggest tax break you can from your charitable giving, you can kind of front load several years worth of donations into that donor advised fund and get the highest deduction possible while you're earning in your highest earned income years.
Thank you, Jason. One last tax planning strategy to consider if you are taking required minimum distributions, RMDs, from your retirement accounts. You can essentially donate all or a portion of your RMD directly to a charity. Your donated RMD is not considered taxable income to you, and you do not claim a charitable contribution for the donation. This is a great strategy to consider if you like to give to charity and you do not itemize deductions. Now I'm going to pass it off to Mark from a wider circle.
Yeah, so this is Jason, just real quick. So thank you, Alp. Some really great practical tips to continue to giving. And so now I want to introduce Mark here and get the perspective of an amazing leader here in our community who's been doing amazing work, and from the perspective of the charities, and because I know with the new tax law, when that came into effect, there was a lot of talk, a lot of press coverage around, gosh, is this going to result in lower giving to charities? across the board from individuals. And I think both from our perspective as advisors, and Mark, you shared this too, that from your perspective with the charity, that you also saw a lot of talk right up front, but that has really quieted down in recent months. And one, I wanted to ask, did you notice any significant change in giving in the 2018 year, which of course was the first year of the charitable giving?
Yeah, good morning or good afternoon. We really did not notice a big difference. We were concerned about that, but the year progressed and right on through December 31st of 2018 with no real change. It was a continuation of what we had seen in previous years.
Okay, yeah. And I think that was really kind of what we were anticipating. And the reason for that was no one had filed their taxes yet and actually seen the results of their 2018 giving under the new tax law. And so now I think between here and the end of the year, probably not over the quiet summer months from a tax planning perspective, but when we get closer to the fourth quarter, people are going to start reflecting really back on, oh, you know what? For our 2018 tax return, we may not have gotten any tax benefit from our charitable giving because of a lot of the things that Alp just covered, the higher standard deduction and the limits on the SALT deductions. So we anticipate that 2019 giving may be the first year that there be some impact on that. Would you agree with that, Mark?
I would. That's what we thought all along. And it will be interesting to see if it affects everybody the same way or if the largest of the major donors are affected more significantly than folks who give below the numbers that you guys just shared in the presentation.
Yeah, so to that point, give us a little inside baseball here on from your perspective, just an idea of kind of the size of gifts that most individuals make.
Yeah, sure. It really does depend on the time of year. You do see the sizes of gifts increase as you reach December, the last month, and then December 31st, the last day. But our average gift has gone from about $100 half a dozen years ago to about $200 now. So that's the average gift. Of course, there's a lot on both sides of that. You still get a lot of $10 and $25 and $50 gifts. You also get a lot of $500 and $1,000 gifts. But I would say on average, we're about $200 per gift.
Excellent.
And that's both in check and online.
And online, yeah. So I was curious, just, well, to that point, I think you mentioned the vast majority is still folks writing checks. Is that?
Yeah, I think for an organization like ours, it's a grassroots nonprofit, very community-based. A lot of our donors are still of the age and generation where checks are the way they give. We do get a good number of online gifts, but it's through checks that we see a lot of our gifts, except on days when we run a matching gifts online. You know, the amount we raise online is doubled, et cetera. Then you will see people participate online, but we still get a significant number of our gifts through checks, through the regular mail.
Got it. Right. I want to talk about impact in just a moment, but just kind of share a little bit more, Mark. Now, another distinction, and as we talked about here in the presentation, a wider circle is able to receive the gifts of appreciated securities, stocks, as Alp talked about. So, and that is a really simple process, and pretty much every 501c3 tax-exempt charity has the ability to set up a simple brokerage account and receive the gift of appreciated securities. And so I really want to kind of emphasize, not only can that be a really smart way to give from your tax planning perspective as a donor, but it has every bit the positive impact to the charity, because they're getting the same dollar amount, sometimes more, right, if folks have highly appreciated securities. And so I just want to encourage folks that even from just sort of a basic mechanics perspective, it's really simple. And most charities, I'll say, when this is a question I get asked fairly frequently, is, well, what do they do with the stocks? And just sort of simply, most charities sell them immediately to turn into cash to utilize to fulfill their mission and do their programmatic work. So I just wanted to mention that. Now, Mark, share with us kind of if I'm a donor and I'm considering giving to a new charity, or maybe I want to increase my charitable giving, but I'm not quite sure who I want to give to, and I want to do a little bit of my due diligence. And what are some of the best practices you would recommend for folks to go about kind of researching, learning about the charity, obviously, to me, first you want to have an alignment of interests and what you want to impact in your life. But then once I've sort of identified that realm, what's a great way of determining, gosh, I feel confident that this particular charity is going to make the best use of my dollars that I donate?
Yeah, I think you want to get a good understanding of their fiscal responsibility. And years ago, when we started to look at how we could engage in best practices financial management, we found out that the Better Business Bureau does great work, Wise Giving Alliance, and so we immediately connected with the Better Business Bureau to see if we could become an accredited charity. And we follow all of their guidelines to a T. And so that's why we put their image on our website. And it's also why we have our financials on our website. So I think if a nonprofit organization does not present all of its financials on its website, that is a flag. I think you should look at that. I think that's probably the best certification that you can get, because it does require you to do it every single year. And then secondly, I think it's really important to visit the nonprofit organization, talk to their leadership, and find out not only how they will use your funds, but what are the outcomes they're getting in their work. Outcomes are hard to come by. Outputs are not hard to come by. It's easy to tell a good story, and it's important. And many organizations are doing really good work. But I do think that if you want your money to have an impact, find out what the outcomes are of your giving to that organization. What are they producing every year? How are they changing and moving the needle on the issue that is in their mission?
Yeah, no, that's awesome. And I think you would probably agree with this statement too. Sort of building on what you just said is, a great way to get to know the organization and see it firsthand is go volunteer.
Yeah, volunteer and really spend some time talking to people who are overseeing the organization to find out not only what are they doing that you can see day to day, but what are their goals, and how can you be assured that they're going to be around? You don't want to give, especially a large sum of money, and find out that in 2 years they've left, they've stopped, whatever the reason that they're not continuing to serve. And again, I don't want to overstate the importance of outcomes. It's one issue, but also to find out that that you as a donor resonate with the spirit of the organization.
Yeah, no, great point. Perhaps I should have started here, but Mark, share with us a little bit about why the work of Wider Circle is so important, and a little bit of sort of your background, how you got to start Wider Circle.
Well, I will do that quickly because obviously the founding story can go on, but basically just seeing how people are living day to day in our nation's capital region. There's abundance everywhere. Everywhere you look, people are living well, yet we have deep pockets of poverty, people living in what I would call deep scarcity, surrounded by abundance. And that makes no sense. That's certainly not a positive reflection of our society. So seeing that as a volunteer, I would visit people bringing food to people who were in need of it. And seeing the scarcity in which they were living was just not acceptable. And so I started the Wider Circle to do a few different things. One was to make sure people had essential items like beds, dressers, tables, chairs, sheets, towels, dishes, pots, and pans. And so we do that. We furnish 20 homes a day at a Wider Circle, but also then helping them to find employment. So we do intensive employment assistance and support, all aspects of it, including trying to find employers to engage more directly and individually with people seeking employment. And then we go into neighborhoods. So Wider Circle sets up in some of these low-income neighborhoods as a service provider so that people do not have to travel to get assistance finding employment or to get assistance with any number of issues, from housing to safety to youth mentoring, et cetera. So working in neighborhoods to me is the future of poverty work and also of a Wider Circle's work.
Yeah, awesome, thanks. Wider Circle has been close to my heart, and Mark has been like family to me. But one of the things that continues to resonate for me, both sort of between my day job, if you will, here at AFS and my volunteering with the Wider Circle, is just I often think about for our economy as a whole, right? That it's such an opportunity cost with so many folks living in poverty and with scarcity, and how much talent and treasure that our country and our economy could grow and benefit from if there was not such dire conditions for so many folks in our country. All right, so I think we're gonna wrap things up here just with a few kind of key takeaways. Really just kind of a summary of sort of the 4 tax efficient strategies that Al covered, around the bundling of donations, utilizing a donor advice fund, especially in your high income years to get the highest deduction possible. The qualified charitable distributions from your IRA. So if you are subject to required minimum distributions once you attain the age of 70 and a half, and especially in a scenario where if you're not going to itemize, you could just send that a portion or all of your required minimum distribution directly to charity and support the causes that are dear to you, and that distribution not be included in your taxable income. And perhaps the most important sort of disclaimer is always have a conversation with your tax professional or your financial advisor to ensure that you're thinking through all the important details. And so to that point, here's contact info for our team. And if you would love to learn more about A Wider Circle, you can always call me. And awidercircle.org. Visit the Wider Circle website, and their Center for Community Service is just located in Silver Spring, really kind of halfway between Bethesda and Silver Spring off of Brookville Road. But thank you all for joining us today. Thanks, everyone.